He just secured a $40,000 profit in a single transaction. His friend, watching intensely over his shoulder, urges him, "Bro, the price is skyrocketing, let it ride. You could easily turn this into $100,000. Ignoring the noise, the trader closes his position exactly at his predetermined target. He banks the $40,000 and exits the market. The friend is absolutely livid. "Why on earth did you close? The price jumped another $30,000 after you sold. You're such a coward." The millionaire trader simply smiles. "Exactly," he replies. This is the story of why the millionaire trader mindset often resembles cowardice, and why that very cowardice just earned him his fourth million. The illusion of the brave trader. Everyone craves the millionaire trader mindset. People associate it with unwavering confidence, intense conviction, and the balls to risk big and win bigger. Most believe it means having the courage to hold through massive drawdowns. You think that's what a millionaire mindset looks like? You're wrong. Dead wrong. I've spent years studying actual millionaire traders, not the ones hawking expensive courses or flexing on Instagram, but the real quiet professionals. These are the individuals with $2 million accounts who drive modest Hondas and live in unassuming houses. What I discovered is that they all appear to be cowards. They bank small wins while others swing for the fences. They flee from losses while others stay strong. They dodge exciting, volatile trades while others hunt them. They risk minuscule amounts while others go big or go home. To an outsider, their actions look weak, timid, and cowardly. Yet, that is precisely why they are wealthy. Survivors versus warriors. While brave traders blow up their accounts trying to prove they are fearless, the cowardly traders survive. Survivors are the only ones who get to experience compounding, and those who compound eventually become millionaires. The graveyard of trading is littered with brave warriors, while the Forbes list is populated by disciplined cowards. In this profession, the most profitable thing you can do is be afraid. Let's look at the numbers. Mike versus Lisa, the cost of bravery. Meet Mike. He has traded euros to US dollars for 3 years, read every book, and mastered technical analysis. Mike's only flaw is his refusal to be a coward. When price hits his 2-to-1 risk-reward target, his ego screams, "Don't be a weakling, let it run. This is the big one." He holds. Occasionally, he feels like a genius when price climbs higher. But more often than not, the market reverses. His $2,000 winner evaporates into a $500 gain or a $300 loss. Out of 47 trades this year, Mike caught only 2 big ones, while 45 hit his stop or reversed. His account is down 23%. Now meet Lisa. She trades the same market and the same setups, but Lisa is a coward. Every time price hits her 2-to-1 target, she closes the trade instantly. No hesitation, no what if. Her friends mock her for leaving money on the table, calling her too timid to make real wealth. Lisa doesn't argue. She just smiles and executes. This year, Lisa took 89 trades with a win rate of only 38%. However, because her wins were always 2-to-1 and her losses were always 1, the math worked in her favor. She earned a 26% return, while brave Mike lost nearly a quarter of his capital. The brutal truth about markets. Markets do not reward bravery, they reward consistency. Holding past your target isn't brave, it's greedy. A $2,000 win in the bank is worth infinitely more than a $5,000 win in your imagination. The broke trader gambles on hope, the millionaire executes a system. The coward takes small wins, compounds them, and eventually becomes the millionaire. David versus Sarah, the trap of holding strong. David prides himself on mental toughness. When a trade goes against him, he refuses to run like a coward. He believes in his analysis and treats pain as a test of discipline. This strength has destroyed 4 of his accounts because he confuses courage with stupidity. When he's down 2%, he holds. At 5%, he averages down to get a better price. By the time he's down 12%, he's paralyzed by the size of the loss and resorts to prayer. Eventually, these 12% losses turn into 35% drawdowns, or margin calls. David has lost $87,000 in 2 years. Sarah, meanwhile, is a coward. If a trade moves 1% against her, she exits immediately. No, let's see if it bounces. Her friends call her weak for getting shaken out by temporary noise. Sarah doesn't care. Even after 143 stop-outs this year, her total drawdown is only 18% because she never lets a loss grow. She is still in the game. David, however, is at 0%. Capital deployment and survival. A study in the Journal of Finance found that traders who cut losses quickly had a 67% chance of being profitable over a decade. Those who gave trades room to breathe had only a 9% chance. The millionaire knows you cannot compound if you are dead. Holding a losing position ties up capital that could be used for the next opportunity. While David is bleeding out in one bad trade, Sarah has moved on to 3 new ones that put her back in the green. Richard and the allure of excitement. It's November 2021. Bitcoin is exploding and Dogecoin is up 400%. The world is obsessed with crypto. Richard, however, continues to trade boring Forex pairs like EUR/USD, just as he has for 9 years. His friends are making $50,000 a week on Shiba Inu and calling him a coward for playing it safe. Richard stays in his lane. He sees the volatility as irrational gambling. In 2022, the crypto market crashes and his friends lose everything. Their $50,000 wins turn into $200,000 losses. Richard, the coward, quietly made $127,000 trading his boring strategy. By 2024, his total profits crossed $890,000. Exciting trades are where money goes to die. Boring trades are where capital goes to compound. When everyone is excited, everyone is usually wrong. The millionaire trader doesn't trade what's once in a lifetime. They trade the same boring setup 1,000 times. Marcus versus Jennifer. The math of position sizing. Marcus believes in high conviction betting. He risks 5% to 8% per trade, thinking he'll get rich faster. He forgets about variance. A string of 7 losses, which is statistically normal, drops his account by 30%, requiring a 43% gain just to break even. Marcus has blown up 3 times, losing $100,000 to $15,000. Jennifer is a coward who risks a tiny 0.3% per trade. Her friends laugh, saying a $300 profit is pointless. Jennifer ignores them and lets the math work. With a 45% win rate and a 2-to-1 reward, she consistently grows her account. After 5 years, she has more than doubled her capital. By year 10, her $100,000 account hits $432,194. Small position sizes feel cowardly, but they are intelligent. Survival isn't about the size of your wins, it's about the size of your losses. Alex versus Daniel, the profitability of ignorance. Alex has an opinion on everything: gold, Tesla, Bitcoin, inflation. He feels confident because he knows the market. But Alex is down 31% because he trades his ego, not the price. Daniel has traded for 12 years and only knows one thing: a specific price action set up on GBP/JPY. If you ask him about gold or crypto, he says, "I don't know." His friends think he's an idiot, yet that one thing has earned him $1.14 million. The millionaire trader doesn't try to conquer the whole market. They find one tiny edge and milk it forever. Admitting "I don't know" is the most profitable phrase in trading because it keeps you out of trades you shouldn't take. The definition of real courage. What does this all mean? It means you must redefine courage. Real courage is cutting a loss at 1% while your ego begs you to hold. Real courage is risking 0.3% while others mock your small size. Real courage is staying boring while others chase get-rich-quick thrills. Real courage is admitting ignorance and staying in your lane. The millionaire mindset doesn't look like confidence, it looks like fear. Fear of losing, fear of blowing up, and fear of breaking your rules. In a game where 95% of players lose, that fear is your primary survival mechanism. The final lesson: look at Thomas. 3 years ago, he was aggressive and fearless, losing $67,000. Then he started acting like a coward. He took small profits, cut losses instantly, and risked tiny amounts. His friends stopped asking for advice, thinking he had lost his edge. Today, his account has grown from $80,000 to $164,000. He didn't get there through bravery, he got there through caution. You have a choice. Be brave. Hold your losers, risk big, chase excitement, and pretend you know everything. Your friends will admire your courage, but your account will hit 0. Be a coward. Take small wins, cut losses fast, stay boring, and admit your ignorance. Your friends will mock you, but your account will compound into millions. The graveyard is full of brave warriors who died with honor. The Forbes list is full of cowards who survived with discipline. Which one do you want to be? Next time your brain tells you to hold strong or let it run against your plan, remember this: be the coward, get rich.